let's get some market perspective now from John Lynch. He's the chief equity strategist at Wells Fargo Funds Management Group. He thinks the S&P 500 looks cheap right about now and could be set for a 16% rally. You say, John, cheap at 1,100. We're just a smidge above that. Tell me what's making you feel optimistic.
Hey, Margaret, good morning. I think, the cyclical strengths domestically are pretty powerful. If you look back to other financial crises, Mexico in the early 90s, Asia and Russia in the late 90s, the equity markets got hit for a period of weeks and months, but then ultimately the cyclical strengths won out domestically. And I think we're in a similar situation. South of 1,100, the market is priced cheaply at about 13 times this year's earnings. And I just believe when investors with all that cash on the sidelines take stock of attractive valuations relative to earnings, book value, cash flow, sales, I think we have an opportunity to 12 months out in that 1250, 1275 range.
Well, the complication there and the big question for the week is what's happening on the unemployment front. Yes, today we did see jobless claims decrease by about 10,000, but at the same time, there's still a sense that there's real fragility there, particularly as we start to anticipate government jobs being lost here, civil servants losing them as states try to pay their own bills. So how do you reconcile that?
Yeah, well, I think the distinction one has to make is if you will, a cyclical bull, a move from, say, 1,100 to 1,250 or 1,275 in the context of the longer-term secular challenges. And I think the conditions are ripe for the cyclical or shorter-term recovery, but I share a lot of your concerns about employment over the longer term. And I think your viewers may want to appreciate the importance of economic improvements at the margins. For example, if we get a good number in employment tomorrow, that will certainly help. The consumer is still 70% of economic output, but if that 70% is growing at a 2 percentage point rate, I think that will be enough to get investors back into equities.
Now, we are seeing this morning a little bit of dollar strength, a little bit of euro slippage. Give me some context here. When you say we're getting more technical these days, what is it that you're looking at?
Well, I'm paying attention to the technicals, certainly a lot of cash on the sidelines. 1105 is a very important number. That's the 200-day moving average. Certainly we broke the long-term trend within the past couple of weeks. It's my hope we can hover in this and find a new base, if you will, within the 1105 to 1120 range. As you know, 1120 is the 50% retracement from the high in October 07 to the low in March 09. So if we're able to find some sort of basing there, I think that will be very critical to start to match expectations with corporate profit growth.
Yeah, when you say cash on the sidelines, I mean, that's a narrative we've been hearing for quite some time, though, and we haven't really seen that cash deployed by the everyday investor out there. So
well, yeah,
why
from the
do you think
individual
it may
investor,
get in there?
Because at some point, as investors see job growth, as investors see businesses willing to invest yet again, we've seen very good earnings in the first quarter, certainly. Top-line growth was strong, and more importantly, businesses were able to hold the line on costs. So as, again, you see these marginal improvements, ceiling on the unemployment rate, floor in the housing market, as we're able to achieve those, I think looking at how many hundreds of billions are parked at the short end of the Treasury curve. We've got about $3 trillion still sitting in cash. Now that's down, and money markets, that's down from 3.8 over a year ago. So we're seeing some, but I'm still very concerned about the fund flows into fixed income as opposed to equities.
So how are you deploying your money right now? What are you buying?
Well, we're looking at a overweight, certainly equities relative to fixed income. I'm looking at a slight overweight for large caps relative to small caps. Within that area, I'm looking at energy, materials, industrials, prime beneficiaries of a lot of the global stimulus, which is still kicking in this year and into early next year. I still like technology. I think businesses are more apt to spend on chips and software. We saw kind of a disappointing reevaluation of the productivity numbers, so I think businesses will step up on that end. All
right. Well, we are seeing the market up, but we're seeing us pair some gains. We'll see how the story plays out in today's session. Thanks for joining us, John.